discuss one space where a lot of market experts have also been bullish on, and in fact Investec has initiated coverage on the Indian life insurance sector, betting on structural growth and a benign regulatory environment. However, it believes that the risks to the sector are increasing as the current high growth levels are unsustainable. Let's discuss more on this with Nidhesh Jain of Investec, who joins us on the show now. Hi Nidhesh, good afternoon, and appreciate you joining us today on Bloomberg Quint. Your report has highlighted that there is resurgence of a lot of these mid-cap players also in this space, and of course there are very limited listed companies that we have. But tell us, what's the core thesis or rationale according to you for investing into insurance companies?
Thanks for inviting me to your channel. We have been covering insurance for last 8 years, especially life insurance sector. The sector has a very strong barriers to entry. If you look at this, one of the few financial services sector which has not seen entry of any new private player in last almost 10 years. And market share tends to get concentrated towards top 4-5 players, which gains a lot of scale, have operating leverage, and that becomes a sort of virtuous cycle, and they continue to do quite well. The risk to and the volatility to earnings is pretty low in this sector. Secondly, still 50% market share is with the government entity LIC, which is slowly losing market share year after year. So given those fundamentals, the sector looks quite attractive to invest. If you look at the history of the sector in last 20 years, there was a patch of almost 4-5 years where the sector has not performed. We've experienced a decline in almost 30-35% in the top line for the sector during those 5 years, and that was only driven by regulatory changes. So apart from regulatory changes, as of now, we have not seen any other risk playing out in this sector, given the underpenetration, given the structural growth stories, and given the structure that I've just explained about the sector. So that gives us quite a bit confidence that sector is on very strong footing. Secondly, regulatory commentary has been quite positive, and we don't foresee any regulatory risk in the near term. So all these things give a lot of confidence in the sector, but we believe that valuations, especially in some of the names, are now reaching unsustainable level, because this is the one sector which has performed quite well in the current turmoil, where all the other financial services stocks were beaten down quite a bit. These companies have performed quite well. Because of that, there has been a lot of interest, and now we believe that valuations are reaching unsustainable levels. Secondly, what we are highlighting is that if you look at the progression from 2011 to 2015, there was a market share concentration toward top 4 players, which are ICICI, HDFC, SBI, and Max. But in last 4 years, we are seeing players like Tata, Birla, Bajaj, and Kotak. They have gained market share, while the top 3 out of top 4 players have lost market share. So that suggests that the small players are also getting competitive, and there is a quite visible price-based competition which is happening in the sector, with the protection pricing coming down. There are experts who are saying that protection pricing in India is even cheaper than protection pricing in Hong Kong and US. Despite having an adverse mortality experience.
Right.
The guarantee levels in some of the products are very high.
Nidhesh,
so there is clear competition which is increasing in the sector.
Sure. So overall view, of course, is positive, hence you've initiated coverage. But let's say if somebody wants to take a fresh bet into this sector, you're advising to buy stocks like ICICI Pru as well as Max Life compared to HDFC SPI, on which of course you have a hold rating. But what's the reason there? Is there more valuation comfort on both these two stocks?
So one is definitely the valuation comfort. Secondly, we have also compared all these companies across various parameters. And the parameters like operating expenses, distribution strength, their persistency, product mix, investment in technology. And we found that the companies are not very, very dissimilar. On profitability, all these companies are pretty close in terms of reporting 20% plus ROEVs, and most of them have reported very strong growth in their embedded value in last 4-5 years. But the near-term growth outlook is varying for these companies. Secondly, there is a differentiation in the product mix and product strategy that these companies have led out in their strategy. So because of these two differences, there has been a lot of differentiation in the valuation front. We believe that on a fundamental basis, there is not that much differentiation that one company should trade at 1.5 times EV and second company should trade at 5 to 6 times EV. So that's why we are betting on companies which are fundamentally strong but are trading at much lower valuations. And ICICI Pru Life is a topic in the sector.
Okay, so ICICI Pru and Max are your top picks. Just a thought on HDFC Life as well, where you have a hold rating, Nidhesh, because that's one stock which has been outperforming. Of course, one reason is it comes from the HDFC, stable, high pedigree management, and of course a group which has given good returns in the last 10 years when you look at the other HDFC twins. So it's got a better product mix, that's what your report states, as compared to ICICI Pru. But in terms of valuation, do you think it's already peaked out?
So on fundamental basis, definitely the expectation from the companies are much higher than expectation from, let's say, Max or ICICI Pru Life. What in the note we have also highlighted that market is expecting that HDFC Life over next 10 years will become twice of the size of ICICI Pru Life, while ICICI Pru Life currently is larger in size than HDFC Life. So on valuation, market expectations are looks quite stretched. Definitely, the near-term growth looks very strong for HDFC Life. What we have seen in the sector is that the sector is not a very high growth sector. In last 5 years, during the growth phase, the sector has seen a growth of 9% CAGR. So it's not a sector like retail credit, which is growing at 20% plus, and the good quality companies can sustain growth at 25-30% rate. My belief is that more sustainable growth rate for a company on a longer term basis will be in the range of 14 to 15%. Market is giving slightly more weightage to the near term, especially FY20 growth, which looks very high. But in future, I think growth will likely to taper down to 15 to 18%, which I believe market is not looking at it right now. And if we do that from a fundamental basis, the valuations will definitely look stretched.
Okay, Nidhesh, it was good to have you on the show, and thanks for sharing your view on the insurance space, which is actually given good returns so far in this calendar year.